Time now for the day's business news, and Stephen Carroll is here. We start off in Greece. This time it's serious.
Yeah, Hala, we've been talking for months now about the prospect of Greece running out of money, and it appears we're approaching that cliff pretty fast. The country's Interior Ministry says they won't be able to pay the 1.6 billion euros owed to the International Monetary Fund in June. Delano de Souza has the details.
It's the clearest sign yet that Greece is out of cash.
This money will not be given. It isn't there to be given. This is known. We are talking on the basis of the optimism that we have. Cautious optimism, but optimism nonetheless. That there will be a strong agreement that will allow the country to breathe once again.
For the past 4 months now, Greece has been stuck in negotiations with its creditors to release 7.2 billion euros, money the country desperately needs to pay 1.6 billion worth of loans to the IMF in June. In an interview on Sunday, the finance minister praised his government's efforts so far and said now was the time for the country's creditors to make concessions.
Greece has made enormous strides at reaching a deal. It is now up to the institutions to do their bit. So we've done remarkably well for an economy that doesn't have access to the money markets to meet our obligations. At some point, we will not be able to do it. And at some point, we are going, obviously, to have to make this choice.
Greece is under increasing pressure to reform its economy in exchange for the funds, an effort the country says it's willing to make, although red lines linked to the labour market and pensions have been drawn. Over the weekend, Prime Minister Alexis Tsipras said the country was on the final stretch to clinching a debt deal, a deal he added wouldn't be accepted on humiliating terms.
Well, let's take a look next at what's happening on the markets. It's a pretty quiet day here in Europe. London and Germany, Frankfurt, I should say, their markets are closed. Their Paris opening slightly down, as you can see, same as the FTSE MIB in Milan. You can see the shares in Madrid after those elections down 1.5%. Hala, I know you'll be interested in this, but shares in Dublin have opened up today. I don't have a figure for you, but have opened up today after that result of the gay marriage referendum over the weekend. Over in Asia, trading is also quieter, with share markets closed in Hong Kong and in Seoul. Some good trade figures providing a boost for shares in Japan, and the Shanghai Composite too up over 3%.
Very good. Glad to hear there's gains in Ireland. Very glad to hear that indeed. Let's turn to technology now. A familiar event, but in an unfamiliar location. Tell us.
It's the Consumer Electronics Show, which we know, of course, for its yearly kind of rendezvous for the tech industry in Las Vegas. But the Shanghai Consumer Electronics Show, or CES, opens today. It's the first Asian version of the event. This, as the Chinese government is trying to encourage startups with measures like tax breaks. But could a rush to the sector be creating a bubble? This report from our correspondents in Shanghai, Clémence Dubou and Paul James.
Every morning, Ting Ting starts her day by checking her mobile device to figure out just how many people have joined her app. 4 months ago, the young Chinese girl quit her job as a finance analyst to develop an app which is specifically designed to help small-scale shop owners promote their shops on the internet.
So they could leverage our app to connect with customers to sell products. So young people get bored of working in big companies, so they really want to do business on their own.
In only 3 months, Ting Ting was able to get an investor to back her initiative in Shanghai. Her backers feel she may be able to become the next Alibaba or Tencent, which are the internet giants currently dominating the Chinese internet market.
We provide actually housing and help with accounting, legal setup. We invest also another $30,000 to $50,000 cash, and in return we get 5 to 7% of the company.
With some 700 million internet users in China, the potential is huge. The Chinese government has been actively promoting people like Ting Ting through tax cuts and other incentives. Authorities in Beijing pumping in 53 billion euros worth of money this past year, which some observers are suggesting may be a bit too much.
If the sector still goes on like that, in 5 years or more, there is the risk of a bubble. Everybody wants to invest on the internet. New enterprises attract lots of money from more and more investors. But most of these companies will disappear. Only few of them will survive. The risk of a bubble is very real.
Even though the Chinese economy overall is on the downturn, authorities in Shanghai are still hoping that 200,000 entrepreneurs will be in the city by 2020.
And we're finishing up, Stephen, looking at the toy market of all things. Which country spends the most per child?
It's Australia, according to a survey from Euromonitor. They spent an average of around €780 per child in 2013, which is the most recent figures available. That's followed by the UK at just over €700, followed by Japan and Germany. Now, Euromonitor expects that spending to rise as time goes on. This is because more people are joining the middle class in emerging economies. It fits in what we've been hearing from some big toy companies, though. Disney, for example, Frozen's been a huge boon for them and their results. And Lego as well, after the Lego movie, has been doing a lot better in sales too.
Oh, super. Good news for them and good news for those kids, especially in Australia. Thanks very much, Stephen Carroll.